welcome to the Soothing Semantics podcast, episode, what are we at already? I think this is going to be 187. I'll have to let you know, but we're nearing 200, and I had the honor of sitting down with 4 of the Owning Manhattan cast members. Owning Manhattan on Netflix, the Sirhan show, blew up. It's getting an incredible amount of views. So I sat down in this beautiful condo at the Paramount, and Jessica and her fiance David, who I'm sitting down with right now, gave me an awesome opportunity and let me join them at their condo and record there. So as always, make sure to subscribe, like, and share. Follow me at Rafi the Realtor. Your Instagram handle is
David W NYC.
Got it.
And also, I also have my own podcast where I talk about finance and investing. It's called the 10X Capital Podcast, 10xcapitalpodcast.com, or find it wherever you get your podcasts.
Make sure to follow that. I'm going to add that in the description so you guys can all find his podcast. So I just had Jessica on my show yesterday, so it will be out soon. And now we are having her other half, David, on the show. I felt it was apropos. He's a brilliant guy. He has so much knowledge to share. This is the first time I'm really covering venture capital on my podcast. So he's going to be the first one to get into that conversation. So thank you for coming.
Thanks for having me. I'm excited.
Absolutely. So we sat down and we covered obviously a lot of real estate when I spoke to Jessica. What got you into the venture capital space? What were you doing the several years prior leading up to it?
Venture capitalists traditionally come from 2 very different avenues. One is working or moving on up in the venture capital world. So they might start as an analyst, then an associate, then a VP, and eventually become partners, similarly to a law firm or at an investment bank. The second route is through being a founder. You start a company, you sell it, and now you could go back and basically give advice to other aspiring entrepreneurs that were at an earlier stage. So I went in the latter. I started 2 different startups. One of them raised $18 million, sold for $25 million. The other one raised a couple million, also sold well. It's still under NDA. And I also, on top of that, I got my MBA from Dartmouth, and I also have a master's in psychology from Harvard. So I wrapped all those skills into venture capital and started a venture capital firm.
You have quite the credentials. Very impressive.
Thank you.
Wow. Okay, so give us, really baby it down for me as well. I was listening to I got through about half, I'll be honest, I got through half of the first episode of your podcast. Give us a little bit of an idea of the basics of venture capital.
Yeah, so there's 3 layers in how I look in the world in venture capital. Mm-hmm. There's the startups. So somebody starts an Uber, starts an Instacart, and they look for funding. They look for funding from what are called venture capitalists. There's also another layer that a lot of people don't know about. They're called limited partners. Limited partners are the money that invests into venture capital firm. So when you see a venture capital firm and somebody says, I manage $300 million fund. What does that mean? That means the majority of that money is coming from other people. They're called limited partners. And typically between 1% and 2% of that fund is their own money. $300 million fund, the general partners might put in $3 to $6 million of their own money, similarly to in real estate. The other $294 to $297 million is raised from limited partners. So I started to interview, and I started a podcast. The first podcast ever focused on limited partners, the people that invest into venture capital. These are some of the richest people in the world. I've interviewed the Rothschilds, the Forbes family, the DuPont family. DuPont used to be the most valuable private company. I've interviewed foundations like Melinda Gates, Ford Foundation, endowments, which are some of the largest investors in the world, like Northwestern, Babson, Baylor, University of Miami, and then also pension system like California, like CalPERS. CalPERS manages, any idea how much CalPERS, the largest pension system in the U.S., manages?
$60 billion?
About $500 billion.
Oh, my God.
One investor.
Oh, my God.
So when people talk about
Wait, you said one investor?
Yeah, it's the California pension system. So it's a bunch of retirees, but it's one chief investment officer runs all that money. So I interviewed the former chief investment officer. When people think about wealth, they think about, millionaires or billionaires, but the majority of wealth is what's called institutional capital. So there's something like 2,000 or so billionaires, people with $1 billion, but there's probably 20,000 institutions with over $1 billion. And some institutions, as I mentioned, CalPERS is the largest pension system, the Norwegian sovereign wealth fund. So countries have their own funds. Norway has their own fund, or Australia. They both have roughly $8 trillion, more than Elon Musk, more than Bill Gates combined.
Considerably more.
One investor.
Because their combined net worth isn't at $1 trillion yet. It will be. You think it is? Do you think combined they have about a no? Because they're what, at 200 billion each, 300, 250?
Yeah, I think it fluctuates. I think Elon's roughly at 3 to 350. Bill Gates, interesting enough, he sold a lot of his shares in Microsoft. He's not even the largest private shareholder. Steve Ballmer has more capital, more of a percentage. Bill Gates would have been a trillionaire if he had not sold his shares, but of course, it's smart to diversify. So he has something like 150, 200 billion. Roughly.
It's such an unfathomable amount of money. It's a nasty, in a good way, I guess. It's so much fucking money.
It's a lot of money, and it actually becomes very difficult to deploy. Right. So when you're investing at CalPERS $500 billion, they have the issue of how do I deploy enough capital in a smart way? Because a lot of the best opportunities in the world to invest in are smaller opportunities. It's just like Warren Buffett has the issue of investing. How do I invest? I think Warren Buffett has over 100 billion in cash. I think maybe closer to $500 billion as well in cash on his balance sheet. He needs to find something that returns more than the market.
What do you mean he has that in cash? How does he have it liquid?
In Berkshire Hathaway, in the fund that he started. So he started an insurance company called Berkshire Hathaway, and he started acquiring companies. But
there's no penalty in withdrawing those funds? How does that work?
No. Warren Buffett, one of the hacks that he created is he was able to grow his whole business by doing what's called share buybacks. So it's a very effective way. So every time he wants to basically, instead of distributing capital, he could buy back shares, which is a very tax-efficient way to grow. But then he moves out of position. So the reason he has so much cash today is he sold his share in Apple. So then he keeps it in cash and he waits for opportunities. And while there might be a lot of opportunities to deploy $1 million or $10 million, there's not a lot of opportunity to deploy $10 billion or $50 billion in an efficient manner. It's its own problem.
This is see, I knew this episode would make my brain. Every point you make, I have like 10 questions. Which is awesome. This is the beginning for a huge learning curve for me, because I know as soon as I first met you, I know that when I do have the kind of money that maybe I don't even need that much, but that's what I want to get into with you is. But let's move that aside for a moment. But essentially, the question I will eventually have is how do people get into this, or how do they? When should they start? Because it's a whole new thing. So. Before we get there, though, with Warren, people always say, don't keep cash liquid. Obviously, I imagine the money is still being invested, right? It's not just sitting in a bank account. Closely.
Yeah, it's a great question. One thing is the biggest competitor. So right now, venture capital firms this year, smaller funds, first, second, third time funds, which are called emerging managers, they've raised 90% less money this year than last year. They're down 90%. And last year was down from the previous year. And why is that? The biggest competitor to venture capital firms are not other venture capital firms. The biggest competitor to venture capital firms is treasuries, because treasuries today are paying somewhere around 5%. So a lot of people, and most people are risk averse, they rather put their $1 million and put it into what they see as guaranteed returns in order to get 5% versus take their money, invest in venture capital, and maybe get 18 to 20%, but also maybe lose your money.
But also it takes a lot longer to see that return, right?
Correct, yeah. Illiquidity is a big issue. If the Treasury was returning 1%, then you have to take that risk. You can't just keep it. You can't put $1 million and get $10,000. It's not enough for people. They'll lose money, or it might be lower than inflation. But when the government's giving 5%, it sucks all that air out of the investing universe, and then everybody's fighting for the scraps, which is why the entire industry and private assets in general have been hit so hard.
Interesting. Okay, so what do you advise people do to mitigate that?
So I think one thing that's really interesting is, and this is why I started my podcast, is most people don't actually know how billionaires invest. Do you know how billionaires invest? So I
grew up so far from being a billionaire.
Me too. So my family came here with $600. We were refugees from the former Soviet Union. Mm-hmm. I certainly did not know anything. We grew up in a lower middle class household in Indianapolis, Indiana. I had to learn a lot of this. It's the first time I'm interviewing people that have never gone on the record to talk about how they invest. Mm-hmm. And if you're trying to be the best basketball player in the world, wouldn't you want to know how Steph Curry or how LeBron or how Kobe kind of do their drills? Same thing with money. If you're investing money, you want to know, one question I have is like, what are the billionaires doing? What are the unknown unknowns? How are they investing that I don't even know about? What are they what's their portfolio construction? So first time in history, I've gotten all these investors to sit down and answer these exact questions. I mentioned before at the Rothschild family, first time they've done media in 20 years. We had the Forbes family, we had the DuPont family, and many other really prolific families and foundations. And I sit down with them and I try to understand how they invest and what the differences are in the different families, the different foundations, and the different endowments. And I could talk a little bit about that. I could try to distill some of that if that's interesting. One of the issues, so finance has two aspects, which is kind of contrary. One is how do you get the best returns? And two is what's called behavioral finance, which is how do you compel people to do what's good for them long term? It's kind of like if you're going to a gym, how do you make sure that somebody goes to the gym every week? And the answer is, in my opinion, is people have to really understand investing on a fundamental basis. So what do I mean by that? I might tell you, it's 2019, I might tell you to buy Bitcoin. Mm-hmm. And you might say, okay, great, that sounds like a great idea. I'm going to buy Bitcoin. It goes up 15%, then it goes down 30%. What do most people do when it goes down 30%?
They sell it.
They're going to sell it because they feel bad. From a psychological standpoint, they have negative neuroassociations to it. They think that they're doing poorly. The people that don't sell, it's not even because they have more self-discipline. It's because they have a thesis that's rooted. They have an understanding of why they're holding it and the purpose of it. Because in order to be disciplined in how you approach investing, you have to understand why you do it. You have to have a thesis. So a lot of people say, what stock should I buy? They never ask, when should I sell? And that knowing what stock to buy
is
exactly
what I was going to ask you, because you were saying that, people have this fear and this self-doubt that as soon as it drops by 30%, they automatically want to sell. So then my next question obviously was, so when should they sell?
I was listening to an interview of Stan Druckenmiller. Stan Druckenmiller, one of the greatest traders of all time, multi-billionaire, self-made. And somebody was talking to him about the psychology of stocks going up and down. And he said, nothing seems as cheap as after it's gone up 40%. Meaning, when something goes up 40%, we feel like we want to buy more. Mm-hmm. When I heard one of the greatest traders, so if you think about what is trading is obviously IQ, but it's also self-control and other thing. One of the most self-disciplined, self-controlled investors of all time say that he struggles with how to manage his own emotions. Mm-hmm. I understood that it's better to really understand how to manage your emotions and also to be really rooted in your thesis, because if one of the greatest traders of all time can't keep themselves from doing the wrong thing, then I better have a really good understanding. And the answer to your question is you buy and you sell based on your thesis. So what does that mean? So in public stocks, so the world of investments could be broken down into two things, privates and publics. One of the things that people try to do with investing is they try to overcomplicate it because they want to take fees from it. They're like charging a toll. If you go to a wealth manager, they're going to use a bunch of buzzwords to make you feel insecure so that they could charge you a fee. But ultimately, a lot of these concepts are very simple. There's two buckets in investing. There's public and there's private. Public are stocks and bonds. I'm simplifying. I'm taking away the 1% edge cases to explain on a simple level. Public, you have stocks and bonds. Stocks, high risk, high reward. Bonds, low risk, low reward. What are bonds? Bonds are basically debt. If a company goes down 50%, they still have to pay their debt, but your stock might be down 50%. Then you have privates. Privates are the sexy part of the market. Privates include everything from real estate to private equity, which includes venture capital. Venture capital is a type of private equity. You have private credit, which is loaning capital to private companies. Even crypto is considered private. And you want to have a balanced portfolio among privates and publics. And I could tell you the different philosophies as to why people have different portfolios. But at a basic level, that's your investment universe. And then you have to figure out what to do with it.
Well, I guess my question, though, is what do you think is the most lucrative? I guess, would you say venture capital because you're in it? What do you think is the...
I ask this question to, if you ask a venture capitalist what is the most lucrative asset class, then you're going to get a very biased response. But I ask this from endowments. I ask this from pension funds. And they all say venture capital, when done correctly, has the highest return. So what does that mean? Just to put some numbers on it, venture capital since 1980, so for 50 years, has returned roughly 17.5 to 18.5% on average per year. What does that mean? That means if you know the rule is 72, so you take 72 and then you divide it by the yearly interest rate, that means every 4 years your money is doubling. That means that in 16 years, your money goes 2 to the fourth power. That means it goes up 16 times. So you put in $100,000 in 2000. In 2016, it's worth $1.6 million.
The way
on average.
The way, say, you have your money in a Roth IRA and you put it into the S&P, you have a similar...
S&P 500, roughly 8 to 8.5% historically.
Oh, versus 17, you're saying?
Versus, 17 to 18. Now, that might not seem like a huge difference. 8%, that's doubling every 9 years. So in 16 years, that's doubling roughly 1.7x. So you put in 100,000 and you get 330,000 or so versus 1.6 million. Huge difference. Mm-hmm. And we haven't even talked about the tax advantages of venture capital. At its best, venture capital is the best asset class. At its worst, venture capital is the worst because there's also a lot of funds that lose money. And we could unpack that as well.
I'm totally into here. Yeah, go on.
So venture capital is this weird asset class where the average return is really good, but the median return, so the mean return is very good, and the median return is very bad. So I think the median return, if you invested into, so what's the difference just to define that? So you make 1,000 investments. Mm-hmm. The average is you add all 1,000 investments and then you divide it by 1,000. Mm-hmm. The median return is what did the 500th best investment make? So it's completely different. The reason the median and the mean is so different, so I think the median is something like a 6% and the mean is 18%. The reason there's such a huge variance is that when venture capital does well, it does extraordinarily well. I do the show with Jason Calacanis. He likes to remind everybody he made a 4,000x on Uber. He put in $25,000 and he made back $100 million. He made that for Sequoia, for a fund.
How fast did he make the money?
It took 8-9 years.
That's insanity.
But 4,000x return is not a 4,000 percentage return. It's a 400,000.
I was saying 400,000%, yeah.
400,000. That's one investment. So that's called...
100 million from 25,000 in 9 years. That's nuts.
That's called, in venture capital, that's called a power law outcome. So the way that venture capital works is that the big outcomes account for, everything else.
Holy shit.
But here's the tricky part. So most people, when they invest in startups, they have an intuition I want to find the best startups, or I want to find the best 3 startups. Terrible idea. Because in venture capital, roughly 2% of companies are these huge outcomes. Mm. Which means that if you only make even 30 investments, you only have a 20 or 30% chance to hit that 2%. You need a portfolio of about 50 to 75 companies in order to have a good chance to hit that power law outcome.
Why does that? What's the significance in that number? Why does it help your odds?
So if you think about every company has a 2% chance of being power law. That means it also has a 98% chance of not being power law. So if you have a portfolio of 10, you take 0.98 and you take it to 10th power. What are the odds that you get unlucky 10 times in a row? That's 0.98 to the 10th. That might be, 0.1%. That means you have a 90% chance of not being lucky.
So to a large degree with venture capital, you're obviously it's the highest. It has the highest risk and it has the highest reward. That's what I'm understanding.
But also, if you do enough of it and if you do it in the right way, then you will get the average, which is very good. So said another way, if you invest into 200 companies, you have probably a 95% chance of hitting a power law outcome, or 99%. Because it's 0.98 to the 200th.
How far should you go down that hole in terms of how many companies should you diversify into? And how much do you spend? I guess it's so situational. You have to look at the company specifically to decide how much of your portfolio to throw into it.
Yeah.
I guess similar to stocks.
There's another wrinkle, which is just like any endeavor, especially with smart counterparties, it takes years to become a good venture capitalist and to really deliver. Famous venture capital fund, Peter Thiel's Founders Fund, they say first year you have to take hundreds of meetings. You cannot invest. We will not allow you to invest the first year because you're gaining knowledge. And once you've got enough reps, just like anything, just like real estate, you start to get a competence. Most people have an intuition of, I'm a great real estate investor. I'm going to invest into great startups. Very, very quick way to lose money. What you really should be investing is into funds. People that have been around doing this for 10, 15, 20 years. And you get two benefits of that. One is you're benefiting from their expertise. Startup CEOs are the best pitchers in the world. It's very difficult, like smart people, Ivy League educated, they know how to pitch really well. It doesn't mean that's a good company. Mm-hmm. So the other thing is with a fund, you get a basket. So think of buying the S&P 500 versus putting all your money into one company. With the S&P 500, you get 500 companies. With a fund, you could oftentimes get 20, 25 companies. There's some funds that do hundreds of investments. So sometimes you can invest in one fund, get exposure to 200 companies, and then you have a very good shot of hitting a power law.
If we're going into that conversation, are you more of a fan? I know the stocks aren't exactly the same discussion, but they have their similarities, right?
Yeah.
Where would you? Are you more of an S&P guy, or are you more of a more selective? Do more buying and selling, or are you of the belief of leave it in the S&P for however many years?
There's a way to look at it. So there's a thing in finance called somebody's track record, right? It's a pretty generic term. The problem is venture capital is such a lucrative asset class. It's called an access class. So the VCs literally pick their limited partners versus the other way around. Mm-hmm. You have to pitch a VC almost to invest, or you have to be early on before they've proven themselves. In the public markets, the same thing applies. If somebody doesn't have a track record of many years across many stocks of generating alpha, the chances are, on average, they're losing money. Mm-hmm. So I'm a big believer in public markets to have index funds because it comes down to fees. Vanguard famously has,
Vanguard.
Vanguard has a total stock market fund, which is kind of like, it's even more than S&P 500. You want to have like diversification. You want to have total index. You want to have emerging markets. You want to have bonds and stocks. And it's much smarter in the public markets is to basically try to get the average versus try to beat the market.
So you're playing the long game, essentially.
You're playing the long game, and a lot of family offices. So family offices, when you make $1 billion, you need literally an office to manage your wealth. It's called a family office. So there's single family office, which starts at about probably $300 million plus to make sense. And then you have multifamily offices, which people that have $5 million to $300 million, they bundle all their money together so that they could pay staff and everything. A lot of them, they don't have public books. They just invest in index funds and they focus on the private market because that's where you could actually outperform. So I'm a big believer in that, but that's also because I'm not a public investor. If I went and spent 15 years of my life trying to become the best public investor, maybe I'd find a way to make money there. But because I don't have that skill, I focus on diversification.
Okay, but in terms of stocks, how do you have it structured? Do you do it
at all? No, I just use index funds. And frankly, I use Vanguard and those kind of customers.
Okay, same with me. So you just have money.
And by the way, somebody worth $10 billion, believe it or not, will use those same structures.
That's what Warren Buffett is a fan of.
Yeah.
Got it. Okay. That definitely helps. Okay. Now, I have a funny question. It's a little unrelated, but it's in the financial realm. When you mentioned the private sector and you were mentioning private money to businesses, what do you think about? Now, I personally don't think it really helps the economy. I think it hurts the economy. But what do you think of private lending in terms of cash advances, daily payday loans? What do you think?
Yeah. So there's consumer and there's business. I think consumer can be very predatory because it's kind of like, for lack of a better analogy, you're giving a fat man cake. And sometimes those could come with 20, 30%.
Oh, businesses, by the way, they can come higher than that.
Yeah. With businesses, I feel like, they're adults essentially, and they're big boys is the financial terms. So they can make their own decisions and they make rational decisions versus, I need to go like gamble on something or I want to go out with my friends. So I think there's a distinction there between personal and business.
Okay, why do you think it differs so much from business? Because if a business is a small business, a small trucking company, they have 5 trucks. Their credit's shot. They need $20,000. They got to pay back. What's a figure of 49% rate? What are they paying back? $35K? My math isn't so great.
Yeah.
So great. They're paying that back maybe in 3 months. I mean, the rate sucks. I personally don't think this is helpful to anybody. I think just because you have a last resort option doesn't mean it's a good one. I think either you should close the business, or if your costs are too high, sell some of the trucks if need be. Keep the business very tight in the meantime until you can kind of get yourself back on your feet, and then you can scale again. Versus taking out a loan. It's not even a loan. It's the credit on your receivables that you can't even pay back normally. So you're working your ass off just to pay these payments.
Yeah, I think there could be blurring when somebody's a single owner of a business and there's basically a pizza shop. There could be ethical blurring between business and personal loans. But there are a lot of, capitalism in our economy is built on debt, and most of the debt is good. Some of it is bad. There's a saying that banks don't want to give you money until you don't need it. So you actually can't really loan that much money unless you could pay it back. So that's one of the things that kind of keeps it more effective. A lot more people would want to take money than are given money. That's one of the kind of levers on the system that keeps a lot of people from going bankrupt.
Valid. Good answer. Okay. Being that I don't know enough about venture capital and it's something I need to study more about, give me some more thoughts. So you can continue on from where you left off. Going deeper into it.
One is, I got a little hack for you.
Sure.
So traditionally, up until a couple years ago, you could only invest in many private assets, including venture capital, by being an accredited investor, which was defined as somebody making $200,000 for 2 years or having $1 million. It's a bit of a paradox.
I didn't know that. I thought it was only $1 million. I thought it was only having $1 million.
Yeah, no,
or making $1 million.
One of those two.
Oh, okay.
And which is, of course, a paradox because you need money to make money. Because you could only invest in the best asset class in the world unless you have $1 million, which is like kind of starting from third base. Recently, SEC expanded accredited investor guidelines to be any sophisticated party. There's actually certain exams that you could take in order to make yourself accredited by a sophistication versus a net worth. Because at the end of the day, there's a lot of people with $1 million that should not be investing in venture capital, and there's some people with $100,000 that should be because they're more sophisticated. So you could actually take these exams and become accredited so that you could open up and invest. And that's not only, you can invest into real estate, you can invest in other accredited-only instruments through this accreditation.
So when you say sophisticated, in what context? What does that
There's
mean?
different licensing exams that you could take to prove to the SEC that you're smart enough to lose your own money.
Yeah, that's crazy. Well, I mean, it's not crazy. It's not crazy. It's actually it's pretty understandable.
It's what you would call a blunt instrument. It actually does apply in 80% of situations. Most people that have made over $1 million are more sophisticated than people who have not made $1 million. Now, sometimes that money, certainly if you've been passed down the money from generation to generation, that would make you less kind of sophisticated. But most people who have self-made $1 million are more sophisticated, all things being equal, than people who have not. But it's a blunt instrument.
Right, well,
it's over-applied.
That's why I guess I'm not understanding the context of sophisticated, because do you mean smarter about money? Do you mean having a better knowledge of money? Is that what you're...
Yeah.
Some of these people actually, I've listened to some of them on podcasts, and they're pretty articulate, and they do other things. But then there are those that are pretty unintelligent, if I'm being frank, and they don't invest their money, and they throw it, they just consume. They spend their money on different items, whether it's guys or girls in that space. So wouldn't somebody lending that person money, or at least accepting their money into a fund, want to know that this person has pretty disciplinary spending habits, or they just don't care the money?
So one thing also to make a distinction between EQ and IQ. There's some very high IQ people that have no self-discipline. They have low EQ. It's not really EQ. I guess it's like IQ versus I believe the word is conscientiousness, the psychology word, which means that you're able to make rational decisions. There's also some low IQ people that are very conscientious. Without mentioning any people, I know a lot of people not very smart that have a very diversified portfolio, that see investments as risky. And they're like, I want to put in stocks, I want to put in bonds, and maybe 5% I'll put in crypto. Low IQ people. They are, in my opinion, much more sophisticated from a asset management standpoint than somebody that's very smart, but he or she might put 100% of their money in crypto or something like that, which professional investors do not do that.
Why do you think they do that? Why do you think their psyche or their personality brings them to
for a couple of reasons. Usually it's because they haven't lost all their money. So a lot of entrepreneurs go through that. A lot of entrepreneurs lose all their money and then regain it for that reason. Because you need to be, in order to build the money in the first place, you have to be sophisticated and optimistic enough to be able to bet on yourself. But in order to keep the money, it's a different skill set.
I love this, dude. I love this.
So making money and keeping money is two different things.
I'm relating to this also. It really speaks to me. It's crazy. I love what you're saying about betting on yourself, because this all ties into a person as an individual going through an entrepreneurial journey.
Yeah.
And so the same understanding is placed on where you put your money.
Yeah.
Because you are also betting on yourself. You're betting on the product. You're betting on the asset. You're betting on the business or the stock. But you're ultimately betting on you.
It takes a lot of humility to sit back, like a lot of family offices that have billions of dollars, and say, we want to make 10 to 12% of our money over the next 50 years. We're never going to make more money than that, but we're never going to make less than 8%, and we're fine with that. That actually takes a lot of self-discipline, a lot of self-awareness, and a lot of patience. And most people do not have that patience.
You give yourself better odds because you kind of know what your odds are and you're happy with those odds, and you know that as long as you can stick with those odds, those are pretty good odds.
Correct. You stack the deck in your favor. A lot of times investment, and for example, venture capital is like the right way to play venture capital is how you play the lottery or you go to Vegas, but you have positive odds. So in Vegas, if you went in blackjack and you had a 56% chance of winning, what would you do?
56% chance, I wouldn't be so confident about it.
Well, you always, let's say in blackjack, I don't know the exact number, you have roughly like a 48% chance of winning. The house is winning, right? Okay. So the more you play...
I'm not a gambler, to be honest.
Right.
That's why
I'm not a gambler either.
Yeah.
So, but if I had a 56% chance of winning, I'd be like, holy crap, I came here with $1 million. I'm going to play 1 million hands. Because after 1 million hands, I'm going to win 56% of the time.
Right.
If I had a 48%, then I might like play and be like, maybe I'll get lucky. But if you play 1 million times, you're also going to get like 48%.
I thought the odds were a lot lower than that.
No, not in blackjack. The only difference is that the dealer gets to go second, so if the player busts, Now, something like poker is a game of skill, but I'm talking about game of chance.
Right.
So investing in venture capital, investing in asset management is like playing blackjack, but with positive odds. So you have to approach it from that perspective in terms of like, how do you make sure that you win? How do you make sure you get enough, diversification, not just by assets, but by year? Mm-hmm. For example, in venture capital, let's say you have $1 million to invest. Let's say you have the best fund ever. You shouldn't invest in that one fund. First of all, it's only 20, 25 positions. But secondly, you want to invest across different years. It's called
when you say positions,
vintage diversification.
What are positions?
Just let's say I have $1 million to invest in venture capital. You should probably invest that at a minimum over 3 years, but ideally over 6 years. So you should invest $333,000 in 2023, 24, $333,000 to 25, and 26. Because even if you pick the right manager in the wrong year, you still could lose a little money or you could not make a lot of money. So you want diversification. So it goes down to the blackjack table. If you know you're going to win 56% of the time, you want to do as many bets as possible because the deck is stacked in your favor.
Interesting. Doing it in different years. Okay.
Yeah, it's called vintage year diversification. You also want fund diversification, which is another way of saying startup diversification, because a fund invests in startups. You want to have the biggest amount of diversification.
Interesting. And is this primarily where you have your money? I mean, obviously you have the Paramount unit. I mean, I guess you have some real estate.
Yeah, I have some real estate. Real estate is one of those assets where you could enjoy it while making money on it and while growing it. So I think it's a great asset class just for personal. But yeah, I have real estate. I have public funds because they're also liquid. So if life changes or we want to do something or I'm getting married soon, you need to pay for the wedding, you could take that money out. Venture capital, your money's locked in for a long time.
So how does the public fund work? How are you making money off of that fund until you pull it out?
It's very simple. I actually invest in, my most valuable thing is my time. I completely outsource my public investments to Vanguard. So there's a hack around this. So I have a 2070 retirement fund. It diversifies among stocks, bonds, international, as if like I need that money in 2070. So it's very aggressive, but yet it's diversified. So whenever I have money, I put it into that, and it acts as a fund of fund. A fund of fund is something that invests into other funds. So it invests into stock funds, the total stock index, invests in the total bond index, it invests into emerging markets. So I'm diversified, but also I'm aggressive. So I just put in my money there. I pay some ridiculously low fee to Vanguard, and I sleep at night, and I take risks in my private markets where I could generate what's called alpha. Alpha is when you get a return for not taking higher risk. In the public markets, I don't think I could actually generate alpha.
We'll go into that in a second, but when you draw funds from Vanguard, isn't there a fee associated? Like, say you want to drop, I don't know how much you drop it on the wedding. Yeah. Say you're dropping $100K on the wedding. Say you're dropping $50K. I'm not trying to put any plants in anyone's minds. Maybe you're dropping $5, whatever it is. How do you withdraw that cash without having to pay any kind of penalty?
Yeah, absolutely. With Vanguard, this is like a commercial for Vanguard. Unfortunately, I don't make any money for Vanguard. But with Vanguard, you have what's called a fee. I believe it's called it's not a service fee. It's a yearly fee for managing your money. The fund that I was talking about, it has I believe something like a 0.18%, which means you invest $100,000. It's taking on a yearly basis $180, I believe. Yeah, $180 per year Vanguard takes to manage my money, manage $100,000. That actually, the way that works is that's taken out every trading day. So there's 250, 275 trading days. Every day it takes out $1. I could buy it in 100 days. I could take out. They've taken $100, and I get to keep the rest. There's no fees for liquidating. It's a totally liquid fund.
Oh, nice. Great.
Yeah.
So that's primarily where you draw funds if need be, I guess? I mean,
that's my that's my liquid portfolio.
Do you keep cash in a bank in general? I mean, I imagine you keep some. But
I do a little bit, and again, because the interest rates are good. So I'm part of that whole reason why a lot more money isn't in funds.
Interesting. Okay. Do you feel comfortable at least tell me like what percentage of your
in cash? It's hard. There's an old saying that if you know how much you're worth, you don't have enough. So it's right. I don't know. Private asset. Yeah, private assets are just hard to value. Every year, every one of my private assets gets what's called K1, which tells me like last December 31st what the private assets were worth. But every day, like they fluctuate based on different factors. To me, cash. So one of the first things. So if you look at yourself as an asset, the number one way to depreciate yourself as an asset is to do something for short-term financial reasons. So the first thing that everybody should always have is a minimum of 3 months runway or 6 months runway liquid. So if you get fired tomorrow, you don't have to find the next job thinking about how you're going to pay rent next month. It's a very inefficient way to make a decision. So you have to have that 6 months. So, that being said, to me, some public securities are kind of like cash. So I kind of put in the same bucket. But at a minimum, I always try to have 6 months of runway personally so that I can navigate anything that comes my way without having to make decisions that are optimized on the short term.
Got it. So without having to make rash decisions. So you have 6 months of your expenses for the most.
And then as you have real estate, you want to make sure you have six months of real estate. So if something draconian was to happen tomorrow, I wouldn't have to sell my Paramount place without, I wouldn't have to do a fire sale.
Got it. You have the funds to be able to take care of any unforeseen.
You want to have the ability to say no to things that are not good.
Incredible, simple advice. Absolutely. Yeah. Okay. And in terms of additional venture capital knowledge.
Yeah. My first hack would be go out and get accredited. Mm-hmm. My second thing is very counterintuitive. Everyone wants to go and invest into a startup or invest into your friend's startup or whatever. I don't think you should have the right to invest in a startup until you've invested in a couple funds and learned about the asset class. So you want to learn as you're investing into other people's funds. And primarily you want to find the funds that have the most amount of positions so that you're diversified. Mm. If you think about from a first principles basis, a fund is just a wrapper around a collection of companies. Said another way, you could have one fund that has 250 positions. That is as diversified as 10 funds that have 25 positions because all they are is just a combination of 25 times 10. If you, let's say you're a listener, let's say you have, venture capital, by the way, is you shouldn't at a minimum expect to get your 1x your money back until year 7 or year 8. So it's a very long-term asset. So
that's something I'm used to, though. I can say I'm a very patient person.
Yeah. So let's say you have at least, $500,000 or $1 million to invest. You would take, 5 or 10% of your money and put it into a fund, call it, 25, 50,000, put it into a fund and not really forget about it, but not expect to get it until year 7. What will you get in year 10 to 11? You'll probably get anywhere from a 2 to 4x return. And also, the way that the tax laws are written, in most states, including Florida, you would get 100% tax-free capital gains on most of your investments. It's called QSBS, Qualified Small Business Stock. Even in New York, they honor that. Not only are you getting 18%, in many cases, you're getting a high percentage of that 18% tax-free. So it's truly compounding just like a Roth, but not within a Roth vehicle. And if it loses money, you write that off. So all your losses you write off, all your gains you get tax-free.
I didn't know about this. This is good.
Yeah, QSBS has been around for many decades. It's actually a very good policy because for every startup that's started, it has such an effect on the economy that it ends up making the entire society very wealthy. It's one of those tax policies that's not just screwing the average man against the rich people. It's actually really helping the economy. Mm-hmm. You don't have to go past the top 5 most valuable companies in the world. They're all venture capital backed. NVIDIA, Tesla, Microsoft, Facebook, Alphabet, they're all venture capital backed. So $1 in venture capital returns many dollars into the economy. So they want to incentivize that by giving you this tax break for your gains.
That's great. A lot of there's also tax breaks with Vanguard, if I'm not mistaken.
There's so if you want to get into nuances, so yes, there's a policy called tax loss harvesting where you sell all the stuff that's down for the year, and then you rebuy them after 30 days. So you're getting all your losses you're realizing today, and all your gains you're deferring. It's called tax loss harvesting.
I think I remember my buddy talking to me about this.
And Betterment and Wealthfront, neither of which I'm affiliated with, will do the tax loss harvesting for you.
Interesting. I got a lot to ask. Like when we finish this pod, because I can go forever. Do you manage portfolios aside from?
Yes. So we're an asset manager. We focus exclusively on alternative investments. So we have a venture capital fund, we have a private credit fund, we have a real estate fund, we have a biotech fund. So again, we focus on, how do we get good returns in a diversified manner? And we help what are called institutional investors, typically investors with over $1 billion. So whether it's family offices, pension funds, endowments, they invest with us. We don't take, most people's money for a lot of different reasons. And we can't even solicit regular people because there's all sorts of solicitation rules. So I can't even talk about these funds on podcasts, except of their existence.
Interesting. Wow. There's levels to this.
Yeah.
Here's a good question. You think of Sam Bankman-Fried. You think about some of these guys who just rip people apart financially.
Yeah.
And they obviously were able to instill a level of trust for these people to give all that money. How do you ensure the people that are investing with you that they can trust you? Because there have been so many scams that have gone on. They've taken hundreds of billions of dollars between all these different people. So the two questions are, how do you instill that trust? Because if they don't know you, they don't know you. I mean, they can check your track record, but Bankman-Fried obviously was able to get these people to do it. How do you instill the trust, and what do you recommend people who are giving the funds, what they should do to be aware or look out?
Yeah, it's important to make a distinction between Sam Bankman-Fried and Bernie Madoff. And I'm not an apologist for SBF, but Bernie Madoff ran a Ponzi scheme. He would take money, and he was committing fraud from essentially, the first day he decided on this business model. So for decades. Interesting enough, almost no institutional investors invested in Bernie Madoff. No sophisticated investors, by the institutional designation, lost money. Why is that? When an institutional investor would go to Bernie Madoff and they would say, we're in like amazing returns. We're interested in investing. Like, can you send us audited financials? He'd say, if you're asking me, you don't deserve to be in the fund. Who does that work on? Unsophisticated investors. He's using all sorts of psychological manipulation
tactics,
like scarcity, social proof. He would say, your rich friend invested, you should invest, right? So that's why not a single institutional investor, or maybe just a couple in the world actually invested in. He lost money of individuals. SBF, believe it or not, he actually did not commit fraud, although he might be charged with it on the cover-up. He took a legitimate business and he took the deposits from that and invested it into like a hedge fund strategy, which he thought would outperform. So he was trying to be too smart. But FTX was a real business until then. Had real revenue, legitimate business model, and everything. He just basically misappropriated customer funds. So he had an underlying real business, which is why people gave him money. Now, there was flaws in his business, and as things, it went from legitimate to illegitimate because he was.
So you think in the beginning he wasn't really trying to fuck people over?
No, he wasn't.
Interesting. You think he was just trying to bite off more than he could chew? He thought he could.
It's the ultimate smart person's Achilles heel is to think that they're too smart. And this goes back to the institutional investors that are good with an 8 to 10% invest versus they say, oh, I'm going to do an 18%.
So he got too greedy. He got too greedy, essentially.
He got too greedy and too overconfident.
Okay. And first of all, what's his sentence now? How long is he spending? Is he serving life?
I thought from what I saw, it was 25 years, but I might be mistaken. And he was very politically connected. That's a whole thing, but that's an important distinction there. To answer your second question,
it's also crazy that his name is Bankman.
Some people call it Sam Bankman fraud.
Oh my God, it's too many things, man. Too many things.
Yeah.
Too much irony. Okay.
I won't go political, but his family is very connected, and it kept him from being charged for a while. It's kind of an unfortunate situation. In terms of your second question, so when it comes to institutional investors, the whole movie scene when somebody comes in and does an incredible presentation will never move an institutional investor to invest. All institutional investors care about is track record. Mm-hmm. Not what are you going to do in the past, what have you done the last
As they should. As they should.
That is the most rational thing.
It's kind of, and I think that works that way with anything. Well, for me, at least, if I have a podcast host that says, I have done A, B, C, and D, and they give me advice, I'm a lot more receptive than if someone goes, I think you should do this, and I think you should do that. Okay, do you have any experience?
Correct. That's a track record. So you need a track record. Ever since, ironically, one of the things that Bernie Madoff, as a result of Bernie Madoff, that was very positive, is now you need to get audited financials. Mm-hmm. So you need a third party to come in and tell you that you have those returns. So it's legitimized the good, and it's taken away some of the risk from investing in these asset classes. Because now everybody, you don't have to trust anyone's word. You have to look. You go to a third party like an Ernst & Young or a KPMG, and they'll actually certify what you're saying.
Got it.
Which is why I highly dissuade individual non-venture capitalists from investing in startups, because, as I said, you could come up with a really good pitch, but until you know all the ways that you should do diligence, all the ways you could get screwed, you will lose money.
They don't have the track record. They can't prove it. Yeah, you're betting your money on what could be.
Yeah, and most importantly, you don't even know all the unknown unknowns.
Well, what if
you don't know what you should be asking?
Here's an in between. What if that startup is run by, say, a number of people that have done not even necessarily similar startups, but have run a few other successful startups? Would that impact your decision?
That's a track record. Absolutely.
Okay.
Yeah. But even then, you could have a startup that sells for $75 million that lost its investors' money, which is why one of the diligence questions should be, how did your investors do in your last startup?
Very good.
But there's like 100 of these questions.
I'm going to consult with you.
And that's why you need to invest. See, there's two different types of costs in any investment. One is the fee. So you might pay Vanguard 0.18%. You might pay a venture capital fund 2% management fee per year. Mm-hmm. Sounds like a lot. Or losing your money.
Right.
So you have $1 million. You could either pay a venture capital firm $20,000 a year to make you money, or you could pay the $1 million in that investment.
Right.
In some things, it's hard to, because the market is so efficient in public markets, you could literally pick 500 random public companies, and you might underperform by 1%. It's as hard to outperform as it is to underperform. In private assets, you could literally lose all your money.
Yeah, that's the scary part. But for the reasons you mentioned throughout the podcast, you still recommend that as the best option?
I think you want to really learn about venture capital. You want to make sure that you invest a small amount of money to start, make your mistakes. Even on the funds, you're going to make mistakes on funds. They're going to be less draconian because you invest in a second-tier fund or a third-tier fund, maybe you make 6 or 8% per year. You invest in a second or third startup, you make 0. So because it's more diversified. But yeah, I would, even within an asset class, size your bets. If you have $1 million to invest $25,000 first couple of funds. Like, make the mistakes on small dollar amounts.
Gotcha.
Be patient, as hard as it is. And meanwhile, put that money into the public markets where it's not just sitting in a bank.
Yeah, okay. Oh, these are valid points. Any other for me, this is, I know I'll have more questions as I learn more about it, as I watch more of your videos, your podcasts, because I'm still a pretty big noob, as you can tell.
Yeah, I have some general ways not to lose money in the private markets. One is, and you'll hear some of the most sophisticated people on my podcast talk about this, like, don't be afraid to ask questions. People come into the industry and they're afraid the first couple of years. They come in with people that are basically making them feel ignorant in order to get their money. Don't be afraid to ask basic questions.
That's the one thing I've noticed, and I don't feel that way with you, which is great.
Thanks.
That is something that actually annoys me when I'm talking to somebody in the financial, and they use lingo that they know I don't understand, and they refuse to baby it. Then I automatically, my guard goes up and I have less trust. You know?
I think it's Einstein that said that if you can't explain something simply, you do not understand it. If you listen to an interview of Elon Musk talk about very sophisticated things, you could always understand it. It's because he has a full grasp of the subject.
Because when I do my podcast, I try to keep that audience in mind and not assume that they just know it all. I think you did an excellent job.
You want me to another thing is there's a thing called the principal agent problem.
Mm-hmm.
Something to be aware of with wealth managers. If you go to, so maybe let's talk about the different ways that people invest with different amounts of capital. So with kind of 0 to 1 million, you're kind of on your own. No one wants to manage your money because it doesn't scale.
Mm-hmm.
1 to 5 million, you might go to like a Merrill Lynch or a Charles Schwab or whatever. When you start with 5 to 10 million, you start to get more sophisticated, people that will want to manage your money. Then you go into 10 million plus. It's advertised as 20 million, but it's really 10 million. Then you get what's called private wealth management. JP Morgan, Goldman Sachs will now want to balance your money. Then at about 25, 50 million to 300 million, you could do a multifamily office. You could team up with other family offices to get access to these Goldman Sachs isn't going to get you into the next great VC fund because they have to deploy billions of dollars, and great VC funds are smaller. So you do that through multifamily offices, and then 300 million, a billion plus, you have a single family office. Mm-hmm. So that's like the stack. That's the problem, is that the people managing your money are not completely aligned with you. It's called the principal and agent. You are the principal, they're the agent. Why is that? Because they get paid typically as a percentage of assets under management. So let's say they get 1 or 1.5%. So you give somebody at Goldman Sachs $20 million. Let's say they charge you 1% per year, $200,000 per year to manage your money. It goes up to 30 million, they make 300,000. So
still a significant amount of money.
Still a significant amount of money. So why aren't they actually aligned with you? Like, the more money you have, the more they get.
Well, probably, but maybe because they're also managing so many other portfolios.
It's because, let's say you go from 20 million, let's say you have a great year and you get 10%. You now have 22 million. Their fee goes up from 200 to 220,000. But in order to get that 10%, you also have to have a chance of losing 5%. So going from 2 million. In one of those cases, they get managed 10% more money. In the other case, they lose your entire book because you're going to go to somebody else. So they're much more focused on you not losing money than you actually making money. Because it's same with the real estate. There's been plenty of studies that show that realtors sell their own property for higher than the people that they represent, on average. And the reason for that is if they spend another 2 months selling it for $1 million versus 900,000, out of that last 100,000, they get to keep 100,000 of that money. But if they're selling it for somebody else, they only get 3% of that money. The incremental work, it creates this principal agent problem. The same thing happens with wealth managers. So they're very focused on not losing money. And most importantly, they do some very complicated things in order to make it feel like they're providing a lot of value. Mm-hmm. But in reality, some of those things not only don't help, but sometimes hurt. They hurt in trading fees, they hurt in taxes and all those things. So you want to be very aware of this principal agent problem when it comes to investing.
Wow, that's very helpful, and it makes so much sense.
And the way to do that is you gauge track record, and the way to gauge track record is to go to somebody that's worked with somebody for 10 to 12 years and say, how have they been? and look for people that have proven themselves to somebody else for over decades. The default is a bad strategy, which is who pitches the best. If you're not looking at track record, you're looking at who is the best salesperson.
And that's not good. That's not a good.
It's not good,
right.
Unless you're hiring a salesperson. If you're hiring a salesperson, then you're like, okay, you sold me the best. You're going to sell my company the best. But if you're hiring an asset manager, the sales and asset management is not correlated.
Well, track record is always going to beat a person selling something. And if you can intertwine the two, I mean, you're golden. If you're a good salesman and you have the track record, it's a no-brainer.
Yeah, exactly. Yeah. So you want to basically go to people that you trust, that have a long-standing relationship, that has seen this person in good or bad times, and you get a referral. That's why so many people do business through referrals, because they're actually a really good way to assess somebody's competency.
For sure, and it works that way in any industry. So here's a good question then, to pivot a little bit. If we're talking about people's money, we're talking about this is a serious,
very serious
topic, right? If you are looking to become an asset manager, you're new, how do you really earn that trust when competing with people who have 10, 20, 30 years of experience?
That's a great question.
Where these people are putting millions and millions of dollars into these people. They're trusting these managers. You come along, you're new, they go, I'm not giving you my money. You don't know how to tie your shoes. So how do you earn that trust in the beginning? How do you crawl through this shit eventually?
That's an excellent question. There's a couple ways. So one is you work at an asset manager. Mm-hmm. So you work at a Sequoia Capital. You work at a Peter Thiel's fund, Founders Fund. You work at Kleiner Perkins. And you build this, you make all your mistakes and you build a track record. It's called an attributable track record that you can now show investors. You could say, I was at Sequoia for 6 years. I returned this amount. Now I'm starting my own fund. I feel like I'm going to do really well.
Okay, so it's kind of similar to joining a real estate team, and you might not get as large of a return, but there's a lot less risk, and you don't. If you screw up, you're under the umbrella of another company. Maybe you're dealing with clientele that are not at the upper echelons, or maybe even you are, but you can kind of hide behind the name if you make certain mistakes. Versus
you gain knowledge and you pay off your ignorance debt. Any new thing that you start with an ignorance debt.
Yes, dude.
Whether you acknowledge it or not.
Oh, my God.
And the only question is it worth it to pay it off? It's not whether it exists.
Sure.
So if I was to start out as a real estate broker, I would have an ignorance debt, and I would be paying that for the first couple of years. And, you have a question of how to best learn quickly.
For sure. And I think that's where you have to have real self-awareness. Are you self-motivated? Dude, I'm really enjoying the shit out of this podcast. Thank you, man. I'm having such a good time. When it comes to real estate or really anything with high risk, high reward, but a huge upside potential, and also a huge attrition rate, is what kind of person am I? Do I have the ability to push forward no matter how many times I get kicked in the face? Or do I honestly need guidance? Do I need somebody to kind of push me?
Yeah.
And so I think that's applicable in any industry.
I have a master's in psychology from Harvard. So a lot of that is understanding your own psychological graph, essentially, and understanding, do you work better within teams? Do you work better as individual? What are your weaknesses? Are you really good at relationship building? Are you really good at tough negotiations? For example, I'm very big at relationship building. I'm not the best at, cutting somebody down and getting that last dollar. And I have partners that deal with that, because unfortunately, when you have somebody that's very zero-sum thinking, meaning they don't care about relationships, and you come in as a relationship guy, you're going to get murdered.
Yeah, you get rolled over.
So I have people at my firm that are able to step in and play that role, and it's super valuable.
Wow, I love what you're saying, because it's so relatable. Because I'm more the relationship building person. I don't like to nickel and dime on negotiations, but I know I can. Especially if the other side, say I'm on the listing side and the buy side comes real nasty, and I know what I need to do, I enjoy it. I don't like, that's not my my preference. I much prefer to have a nice, smooth interaction with the other agent. I want to partner and make this happen together.
Yeah.
That's always my avenue. I never go into it, even on on the buy side, like, dude, let me try to.
Yeah.
I want it to work. I want to be happy. I want to be able to shake the agent's hand and say, I'm glad it worked out for your client. I'm glad it worked out for mine. Let's grab a drink. Let's grab a bite to eat. Awesome. But the moment they come at me with that kind of attitude, yeah, there is a part of me that gets a little bit,
Well, there's also this concept of compounding games.
Okay.
So right now I'm working on a deal with a $100 billion asset manager. And I know that I could get them down to a very specific deal, but we're actually putting in a way for them to make a little bit more money, both because I think it's a better way to live, but also we want to do another deal. It's roughly a $100 million deal. I don't want them to know that.
Okay.
It's roughly a $100 million deal. I want to do another $100 million deal, and I want to do another one. So part of me I don't like when everything's just like down to the last dollar. I don't think you have to do that to make a lot of money in business. And B, part of it is just a rational thing. I want the money behind that. And what happens in compounding games and compounding relationships is that typically the next deal is much bigger. So this happens to be a big first-time deal. I've known this guy for close to a decade. But typically you'll do a smaller deal, and you might go from a $5 million deal to a $100 million deal. It does really compound if you treat people well. Now, that doesn't mean that you should be taken advantage of. You should have them treat you fairly because you don't want to be in a relationship with somebody like that. But there is something to the non-zero sum nature of relationships and deals because almost nothing is a one-time deal. Like in real estate, you might think it's a one-time deal, and then you see that agent next 3 months later.
Fantastic advice.
So you want to balance those, and it's hard. It's hard to have all these aspects in one person. So it's really useful to have a team around that could play different roles.
So that's why
you don't seem schizophrenic. One day you're like, I want every last dollar, and the next day you're like, I want to build a really long-term relationship.
I want to be nice today. I want to be nice.
This person has like multiple personality disorders.
Right. Sometimes I feel like Ryan Serhant though can balance those pretty well.
Yeah, he is very good at that.
He balances them very well. He's very smiley and very jumpy and bubbly, and he can put on a fucking costume and run down the street. But
and a lot of times that, it's like a dog. You don't go around barking at people, but if somebody takes your treat, if you show your teeth once, the person understands.
Yep.
So sometimes strength, you just need to show it at the right time. You don't have to show it all the time. Phenomenal. And Ryan's like that. Like, Phenomenal. You can never mess with him. So he probably doesn't have to show it that much. That's his reputation.
That's so you put that beautifully. And I think that's true on an individual level, especially when people first meet you, whether that's an interaction between man and woman in relationships. The sooner you set boundaries when you meet the woman, or you're the woman meeting the guy, you set certain boundaries, standards, values up front in the beginning, and you're firm, then they will respect those boundaries a lot more than if you do it a year later and suddenly wake up and go, oh, by the way, this is actually really important. You can't do that, or this has to be a certain way.
Yeah, and if you wait, your partner might say you've gone psycho.
Totally. Like, who told you this? Who put this in? Who planted this in your brain? This is so interesting, dude, because I think about these things. Ryan, that's so true. And also, what I think, to even expound on the showing your teeth once, is you need to actually have the knowledge. When you know something and you can break it down to a science, Ryan knows a particular street, or he knows a particular building so well, and somebody tries to one-up him or out-strategize him, meeting up maybe on the other side of the deal, but he knows his shit so well, he's not worried about how it's going to come off if he's very blunt or brash, because he knows what he's talking about.
And also, if you know the building really well, you could just say, no, like the average is 1,000 per square feet. We're not going to take less than 950. We just can't. And you could just say it in a calm way, because you know your stuff. A lot of times people get triggered because they don't actually know. So they're worried that they're getting taken advantage because they don't have enough information.
It's so true. It is so absolutely true.
So that's why it's so important to have a BATNA, best alternative. You want to know, if I don't take this deal, what is the next best deal? Because then you'll never take. If you have a B+ deal on the table, or even a B- deal on the table, it's incredibly powerful because you will never take a C+ deal by definition. the worst you'll ever go out of that negotiation is with a B- or B outcome. The worst. So it's oftentimes really good to have other alternatives and to really know the market, because then you won't. It doesn't matter actually. Like, let's assume you are the biggest pushover in the world, and somebody comes in. They're like, I want to buy this place for $950,000, but you have another offer for $1 million. You could be like the biggest pushover, like the least spine person. You're not going to take $950,000.
Right.
Be like, why? I have an offer for $1 million.
Totally.
You might be very apologetic about it. Be like, oh, I'm so sorry. Like, I hate to disappoint you. But you're not going to take a.
I also have a hard time. I also have a hard time understanding that, though, when people are so overly apologetic for things like that. It's interesting.
Yeah.
And I think
most people didn't go to the army, so that gives you more assertiveness skills.
Yeah, it helps. I'll be honest. I didn't grow up with a father. My grandmother raised me, but luckily she was very tough. So I definitely got that from her. But this actually took me time to develop. I'm still not. I don't like to be. I have no problem being confrontational, but I very rarely am. Very rarely am, and I don't like to be. I just kind of keep it there if I need it. But I have a harder time with it when I don't know enough about something. When I know my shit, I'm very willing to be balls to the wall about something, and whatever it is. So once I'm, God willing, now I'm about 3.5 years in real estate, going on about 4 years. I think once I'm even, 7, 10, 15 years in, and I've sold big deals, and I've closed a considerable amount of properties, and I've worked in all kinds of markets, it'll be very hard to sway me on certain things.
Yeah.
And I think no matter what, I'm going to be very nice and respectful to people, even if they're brand new agents. So long as they're nice to me, I'll be nice to them. But I definitely have that other side too. And I think it's important in business.
Yeah.
I think it's important.
And unfortunately, sometimes, especially if somebody's not providing the respect, or if somebody's not really either aware or providing respect or respecting other people's times, sometimes you do have to be firm, because sometimes people just don't listen.
Totally. This is great. Yeah, we're covering a lot of ground here.
Yeah.
Wow.
I've been thinking a lot about this investing construct, and so on my podcast we talk exclusively with institutional investors, like these very sophisticated people. And I got all their friends on the podcast, so now they go on the podcast, and we nerd out pretty hot. But I've been thinking about, one of the reasons I want to do this podcast is, how do you transmit what these very sophisticated investors are doing into simple strategies for everyday people? And everyday people is like people under $1 billion. So basically everybody. Me too. The answer is, you want to really educate yourself. You want to start with a B strategy. Not over-optimize and improve. A B strategy is have a diversified set of stocks and bonds. Mm-hmm. Maybe stocks, U.S. stocks, emerging markets, much smaller, bonds, U.S. bonds, emerging market. And that's a B outcome, and that's great, because most people just don't end up investing at all. So what does it take to get the minimal amount of information in order to make, good investment decisions? Maybe you're not Warren Buffett, but you could compound a lot of money just by making good investments and doing things like a Roth IRA and all those things. There's a lot of financial podcasts. And then as you gain more capital, start to explore the private markets, which is what my podcast is 100% on the private markets. And how do you become smarter in those private markets? Because that is how you could build real wealth and really compound and have a lot of tax benefits and stuff like that. So I've been thinking about how to bring that together, but I think you want to pay the ignorance tax as soon as possible, and ideally without money. Oftentimes, you could learn from other people's mistakes.
Sure.
It doesn't have to be your own mistakes. Some mistakes need to be learned difficultly, like Sam Bankman-Fried. I don't think he learned from it. I'm sure he saw other people that lost money, and he comes from a wealthy family. He had to learn it the hard way. He had a thick skull. But also probably the reason for his success too. He was betting on himself. But ideally, you don't have a 25 years prison sentence before you learn lessons in business, and think about, how do you educate yourself and how do you pay down that ignorance tax as quickly as possible and in small bets as you learn and pay off that tax, because that tax is there whether you acknowledge it or not. And then how do you build wealth over many generations?
Definitely. Awesome stuff. I think a big reason people don't make these decisions in investing is because they're too afraid to be rookies. I think that's why most people don't make most decisions. They don't want to suck at something.
Yeah.
They don't want to be in the beginning stage. They want to be a pro. They see other people being pros and they go, oh, I want to be like them. I don't know how long it took. It looks too stressful. Or they get jealous and kind of bitter and they're like, oh, they're so good at it. I'm never going to be like that. And they just don't bet on themselves. I see these big podcasters. I see these big realtors. I see Ryan Serhant. I don't need to be as successful as the best podcaster. I don't need to have as many views as Joe has or close as many deals as Ryan has. But I know for an absolute fucking fact that I can close a $10 million deal. I know I can close a $20 million deal. If I don't do it on my own, I know that I can, bringing my broker on, one of my two brokers on the deal with me, will get that deal closed. I just need to earn the seller's, actually get that conversation, set the appointment, bring one of my brokers on, co-list it, and get it done. I'm fully, I have no doubt in my mind. The question is how long am I willing to work and toil and bust my ass in order to actually earn that deal? And I know it's
say a couple of things on that. One is I've interviewed people like the founder of FT Partners here in Miami, Steve McLaughlin, the world's richest banker.
Yeah.
That's his nickname, and he probably is the world's richest banker. He's been building that business for 25 years after he left Goldman at 32. The compounding of effects is astronomical and always undervalued. Ryan, I think, has done 5 other reality TV shows. He's been doing real estate for 16, 17, 18 years. Don't compare yourself with somebody in year 18. Compare yourself in somebody in year 3 and 4. The other thing that I'll say is you could be good at anything, but you can't be good at everything. So if you look at the most sophisticated investors, like even Stan Druckenmiller, I actually got to pitch to his family office. And he is the world's greatest trader. But we were talking about for a company in the Bitcoin space that's now done really well. It was a startup. He invests his non-trading money. He brings in professional managers. Venture capitalists, the smart ones, they invest into private equity managers, into private credit managers. They don't try to say, I'm going to be a private credit manager. That's foolish. That's egotistical. Mm-hmm. So pick your lane, be world-class at it, and pay for talent, aka managers, that will bring you returns, or Vanguard in the public markets, that'll bring you returns in other asset classes. Don't try to be the best. And don't even try to invest into anything that you're not willing to spend 5 years into. That's why I'm such an average public investor, and I'm happy with that, because I make my alpha in the private markets. So really know what you're trying to be world-class at, and limit your time and effort into that, and be willing to say that you're not good at certain things and be okay with that.
Incredibly good advice. For me, it's really, I want to be an exceptional residential luxury realtor in South Florida. So that's primarily Miami-Dade and Broward County. Maybe a little Palm Beach. We'll see what happens. I've done deals there. And continue to do this podcast. And I know I do a broad podcast, but stay consistent. The more money I have, the more I can delegate tasks to free up my time. So this way, the only thing I want to have to do is do my research on a guest, decide who to talk to, decide who to bring on, do my research, and sit my ass down. That's about all I want to be doing. I mean, there might need to be a few other things I need to do. Maybe, obviously, building relationships. We may go out to dinner with the guest. We'll be communicating, getting to know each other. But I don't want to have to be worrying about editing, what kind of clips, et cetera, et cetera.
Yeah.
So when I can do that, the podcast will be much simpler to do. It really isn't that complicated. I spend most of my time doing real estate. And then with real estate, having a full-time manager, a full-time assistant, and the more money I make, the more I can delegate, so I can go on vacation and not have to think about it.
There's no form of self-care that's better than picking people, than loving yourself enough to surround yourself with people that are good at the things that you're not good at. It's about giving yourself grace. For example, me, I'm not great at CPA and accounting and basically doing bookkeeping type stuff.
I totally thought you were, by the way.
I have a podcast LLC, so I have a bookkeeper that comes in. I'm just not good, and it's probably just because it's not worth my time. I have somebody that comes in and does the expenses, 1099s and all those things. Could I learn to do it? Yes, but I hate it. And I give myself the grace and I say, you're a great podcaster. You're a great business guy. Let somebody help you. Mm-hmm. Like, leave room in your life for somebody to come and do things. And by the way, the CPA that I use, she's really good at it. She's exceptional and she loves it. And why are you taking that away from somebody else? Why are you not allowing other people to be in their domain?
Totally.
So I think that's a huge point of self-care versus saying, "Oh, I'm not good enough. I feel guilty that I'm not good enough, or I have to do this and I hate it." Have the grace for yourself in order to find people that could help you in your business.
Great advice. Another just bomb after bomb, man. Thank you. No, really, I'm
all advice. All this advice was painfully learned.
Yeah, and I
paid with my ignorance debt.
Sure, and I think the best part about it is it's not that necessarily all of it is so new. It's that you're articulating it in such a way and you're reassuring it to me, and it's so important hearing it because I think you're a very intelligent guy and you've taught me a lot today that I never knew. And hearing these principles, these life principles, articulated in such a way, it's very helpful. So I appreciate that. Are you Carpathian?
Sorry?
Are you Carpathian?
What is that?
You know what that is?
No.
You said you're Jewish from the Soviet. Okay, because I know there's a specific. I figured you knew what that was. They're from I think like a part of Russia. They live in the mountains.
I am from basically Siberia, close to Siberia. So I'm a tough guy.
And
I am a Kohen, but I'm not. I don't know what a Carpathian is, and I don't think I'm a Carpathian.
You know the Count from Sesame Street?
Yes.
Whoever created his character, he's a Carpathian Jewish vampire count.
Interesting. Well, I need to check out the Wikipedia.
He said, "My family from the Carpathian Mountains." It's like a scene he did. Anything else you want to mention? By all means. We've been talking for about an hour and a half, so I think that's a solid amount of time. So we're good on my end. I would love to do this again sometime.
Yeah, absolutely. And my passion, my day life is investing money, and my hobby and my second career is a podcaster as well. And I have this passion to bring in the top investors in the world and put them on the record. No one's ever done this. No one's ever talked to these families and institutional investors. They've never actually been willing to go on camera. I have my own secret sauce on how I do that. I've built really deep relationships. So I want to create a depository for everybody to be able to go and listen and learn about that. And if that's something that's interesting, check out the podcast. It's called 10X Capital Podcast.
You could
check out the podcast, 10X Capital Podcast. We're number 4 in the United States in investing. We're number 150 overall podcasts in the United States across all categories, number 25 in business. Would love for you guys to check it out, 10xcapitalpodcast.com or on Apple, Spotify.
There you go. Make sure to check it out. I will be checking it out. I'm going to finish the first episode. I'm going to watch more of them. So thank you again, David. It's been a pleasure having you on, and thank you for the insight. Really a great episode.
Pleasure is all mine.
Thank you, man. So, ladies and gents, another episode of the Soothing Semantics podcast has just finished. I thank you for making it this far. Make sure to subscribe, smash the like button, leave your comments. And if you do want to get in contact with either of us, our info will be in the description. Social media handles, his podcast, Instagram pages, my YouTube channel, all that jazz. If you want to ask him anything about venture capital, all that will be very accessible. Thank you again for joining me, and I'll see you on the next one.